Here today, let's compare the most recent market advance to two other periods when the S&P also did very well in a relatively short period of time. And so, number one, starting with the fourth quarter of 2019. And as you recall, back then, it was a pretty substantial, very consistent advance all the way through the end of January, where the market started off near the October low, coming off of a relatively volatile period just before it, coming down in May and August. And then, really, when the fourth quarter began, the 1% moves just disappeared, right? There was over 70 days without a 1% decline and just about the same length of time without a 1% gain, right? And over that time as well, large cap tech dominated, right? And so we can see how that is related to the XLK versus S&P 500 relative line here. So that's different so far with now, of course, there hasn't been a 1% decline in about 35 trading days now, but we have had bursts, of course, of 1% advances, especially at the beginning of the rally from late October to early November. And in terms of what has happened from a leadership perspective, started off being large cap tech, but we know recently that has changed with a lot of smaller areas doing better. And so the other period, of course, is after the COVID crash, the comeback. And so over the first few weeks, again, very substantially higher, continued higher, but at a slightly less strong slope going forward. But the big difference here was that you had a huge amount of moves, both up and down on a daily basis, which caused a lot of back and forth movement and very volatile. And that volatility lasted all the way really into the second quarter of 2021. Can't really tell from here because these 1% bands look very narrow compared to what happened here, but we know there was just an overwhelming amount of big moves in either direction, and even the drawdowns were substantial along the way as well, even as the market continued higher. And really, that is the number one difference between now compared to both of those times, where the drawdowns really just have been non-existent. And we actually talked about this a few weeks ago in the video, talking exactly about that, how we haven't had any opportunity to quote unquote buy the dip so far. And so we see how even different that is compared to what happened from April to July. The pullbacks were relatively small, as we thought, at least back then, not getting more than, say, 3.5%. But right now, of course, we're extended, waiting for something to change along the way. But because the drawdowns have been so small, it has allowed the bullish patterns to continue to work, right? And we saw that here where we had the breakout from November 10th, had an upside target 46.75, which now has been achieved, was acquired back on FOMC day this past Wednesday, and has obviously continued higher little by little over the last 2 days. Also had a bullish flag pattern achieved as well. Again, this is just a few days of pause here in the middle of November after the CPI induced huge rally, and then continued higher as well, right? And so that is leaving us with now this upside target of 5,030 after pushing through this inverse head and shoulders pattern just say a week and a half ago. And again, this isn't a classic right shoulder, not by any means. Getting something further down here near 4,400, which we had talked about potentially happening, which didn't happen, of course, but it was a consolidation near a key resistance line, which then resolved higher. So in our book, that constitutes another breakout again, and this would be much higher, giving us a target above all-time highs by a good deal, right? And so along the way, we know it's been much more than the S&P 500. It's been many other indices and ETFs that actually are more overbought than the S&P is. And one in particular, which caught our eye, of course, is the Dow Jones Industrial Average. Running a screen recently, one of the ETFs that this is represented by DIA Diamonds was at the highest RSI of any of the non-leveraged ETFs that we follow, hitting almost 85, right? Shows exactly how broad this rally has been. And so a few things stand out. Number one, haven't had a reading this stretched all the way back to January 2018, right before the vol implosion, remember, of that year. Now, we're very careful in framing things this way. We're looking back at the last time something happened because we want to see really what's much more important is the first time that we had a very strong overbought reading after a period of volatility before it. And that happened in December 2016, right? Which that means it occurred before the very strong, very consistent, non-volatile advance in 2017 happened, which of course extended and got even stronger as January 2018 began. I think it's also very interesting to see like the 2 years before what it looked like, right? Comparing 2015, 16 to what happened from 2022 to 2023, where we had back and forth volatility, of course, then finally had the low, still didn't look anything different as it got to previous high. Then the breakout occurred, and all of that is what produced a very stretched overbought reading, which then happened again and again as the extension then continued. Right now, of course, same type of thing where not exact, but similar. 2022, the comeback still was relatively volatile until the second quarter of this year began. Finally got the breakout that produced the very strong RSI reading. We know that can't last. However, as it backs and fills, can continue to hold this breakout zone and somehow replicate this going forward. Now, we won't know this, of course, over the next few weeks, but definitely something we'll be paying attention to into 2024. That's it for today. Don't forget to check out these videos and subscribe. I'll talk to you next time. Thank you.